Hello and welcome to MF Corner. I'm Sonal Bhutra. With me as always is Vinnii Motiwala, and today it's going to be very interesting because a lot of topics that we'll be discussing. The first one, of course, on what's happening with that surge in gold ETFs, the interest there, and there's so much to discuss on what the investors should do right now.
Absolutely. It's going to be that, right? What are we going to be discussing in terms of gold ETF? And let's talk about why passive funds also. Look at the traction that they've picked up, especially in the last 1 year. If you look at the AUM growth for passive funds as a whole, from October 2024, it was 11.21 lakh crore, and now it's moved on in October 2025. The AMFI data that we last had came in at 13.67 lakh crore. Obviously, that's a growth of 21%. Even on a month-on-month basis, just in the month of September to now, we've seen a 5-6% growth there as well. So passive funds overall, that's where interest is coming in from investors as well. But gold ETFs, there's no stopping that, right? And despite those gold prices rising, everyone wants to continue their story there. So that is what everyone wants to focus on as well. But what does it mean now? From here on, where are we going to be headed? What will it mean in terms of a gold ETF growth going forward? Silver ETF. Silver itself as a metal has done so well this year, right? It's actually outperformed gold. Does that mean, with the silver ETFs, this run-up that we're seeing is going to continue? And where should we put our money on the passive fund side? Should it just going to be this index fund that continues to trend, gold ETF, silver ETF, fund of funds? All of that is what we're going to be focusing on. And as investors, especially this time period where gold has seen such a run-up, especially over 2023, since then, it's not stopping.
And, there's a very interesting note from Motilal Oswal as well. They speak about how passive funds flows have increased 278% because of surge which we have seen in index funds and, of course, continued growth in ETFs. So ETFs continue to be our focus point as well. So let's get going and get our first guest for the day then, Vinnii.
Absolutely. Let's bring on board Kaustubh Belapurkar, Director of Fund Research at Morningstar Investments, joining us right now to discuss all of this excitement that we're seeing in terms of passive fund. Kaustubh, good afternoon, and thank you so much for joining us on the show. First, let's start by talking about passive funds, right? The AUM that's seen a very good growth of 21% on a year-on-year basis. This is for October 2025. Obviously, this was mainly the growth came in because of precious metals, ETFs on that front. How are you seeing growth from here on for all of this, whether passive funds or even gold ETFs? Do you think this is sustainable? Or now maybe we'll see it normalizing or reducing a bit more from here on?
Firstly, Vinnii, Sonal, and thanks for having me on the show. I think very interesting conversation and some very pertinent questions there in terms of what we're seeing in the passive fund space, and particularly about gold and silver ETFs and funds, right? So a couple of points there, I think very important to acknowledge. I mean, passives obviously, as a segment, it's a pretty broad segment, and we'll talk a little bit about in detail. But generally we've seen a fair bit of interest coming in from, primarily initially was institutional money, especially EPFO towards the broad-based indices, but more recently, last couple of years, there's obviously been more individual investor money that's also been coming in to passives across the board, right? That's the first trend that's clearly visible, and we think from an industry perspective, obviously the industry assets are growing quite significantly, so it's not going to be passives at the cost of actives. I think both are going to continue to grow, but as we're seeing passive share in the market, as in the overall industry AUM is slowly inching up, right? It stands at about 70-odd%. Maybe just 5 years back, it was shy of 10%. So, the growth of passives has kind of, been faster than the active space. More importantly, about what's happening in the gold ETF. Now, that's a very interesting, sort of segment that, so gold ETFs have actually existed for a fairly long period of time. Silver is probably a more new product class, but gold ETFs, some of the ones have been in existence for perhaps even 2 decades now. But what's happened is just that sheer pace of rise of both gold prices and silver prices over the last couple of years, and silver more recently so. What that's done is that attracted a lot of investor interest in looking at investing in these ETFs that can give you exposure to the underlying commodity. But I just want to play the devil's advocate, while and we'll obviously talk about uses of gold and silver in a portfolio. But sometimes just that whole perception of having come in after seeing the sharp rally and piling on more and more to gold, I think investors need to just take a sense check about why they're adding gold to their portfolio. And I think if, gold does correct, or, we see some volatility in the interim, flows might actually slow down or taper off, because, investors do tend to look at more recent returns, and they might want to take a kind of sense check of, how much they want to allocate to these ETFs.
The recency bias always, takes center stage when we see such massive surge in certain categories. Take that point, Kaustubh. But now we are talking about inflows into index, other ETFs remaining strong, right? So how do you see the mix between equity index funds and non-equity passive products evolving, say, in the next 12 to 18 months? Because while at 17%, the figure has increased from 10 to 17%, even the denominator has become so big.
Yeah, absolutely. So I think, two very important points to highlight here. The first one, that alluded to the type of investors that are investing in index funds or ETFs, right? So ETFs largely, like we said, was predominantly institutional investors, pension fund money that started off many, many years ago. But in more recent times, you would see investor interest increasingly towards, what we call a broad-based index funds or ETFs, right? So indices, ETFs that are based on, say, the Nifty 50 or the Nifty 100 or your BSE 500, NSE 500. So your more broad market cap indices, which would give you a broader market exposure, right? Then we had certain other types of ETFs. We spoke about gold and silver ETFs, which have obviously gained a lot of traction in more recent times. But we've also seen interest in the past with fixed income passives, right? Where you had these target maturity funds, where obviously there were a lot of launches maybe a few years ago, but now with taxation, I think those have taken a backseat. In fact, in the recent year, we've actually seen outflows from quite a few of these strategies, given where interest rates are and the volatility that's been there. That's been a space that's actually been shrinking in terms of assets. The other space which also caught a lot of attention in terms of fund launches in the previous years was actually around the thematic, smart beta, the more narrower based passives. Now, while they didn't, the assets weren't huge to start with, but if you look at more recent trends, that space is also losing certain assets. Investors are taking some money off, say, from financial services, healthcare, technology, ETFs, albeit, obviously smaller numbers. But if I think about the longer term trend, right, like I said, I think actives and passives, the industry is growing. Like I said, the denominator is growing quite significantly already. Passives are definitely gaining a strong foothold, but I think they don't need to necessarily grow at the cost of actives. So I think both can coexist, depending on the way an investor wants to position these funds in their portfolio. But I think the focus will be on more broad-based equity indices, the ETFs. I think that's where a lot of the action will continue to be there. There could be sporadic flows into more thematic smart beta ETFs or golds, but I think equity ETFs would be the primary driver of the assets in passives.
Okay, equity ETFs you think could be the drivers. But, Kaustubh, obviously, does this also bring the point towards more concentration that's actually come in the recent times for passive inflows coming from gold and silver, and the risk that comes in with that as well in terms of market concentration? And also, how should one be allocating, now to gold in terms of a percent of portfolio?
Yeah. Great question, Vinnii. I think a very important thing to talk about, because one is clearly what we've seen is outsized allocations from a flows perspective in the past year. In fact, if I just break down flows in gold and silver ETFs, I look at 3-year data. The first 2 years, 23, 24, we got probably 20,000 crores in gold ETFs. Then the next 9 months, up until August of this year, you got another 20,000 crores. So 2 years flows, 20,000 crores, up until August, 9 months data, 20,000 crores. The last 3 months, I've seen 28,000 crores in just this short period, right? Obviously, because suddenly now investors are getting very excited about the kind of returns that have been delivered in the past with commodities such as gold and silver. And here's where I think it's a very important conversation to have, for us with investors, because while obviously these returns, we've seen these significant price increases, and for various reasons, obviously, from macro to geopolitical to the whole tariffs and trade war, US dollar sort of weaknesses, all of that kind of contributing to the safe haven, especially with gold. But if I just go back in history, right, when you think about, if I go back in 2011, when gold had made its previous peak, almost close to, I think $1,900 was the level at that point of time. For a very long period of time, if I just look at it in US dollar terms, gold didn't go anywhere for almost 7 to 8 years, right? So I think, we tend to forget history. And gold's actually been a pretty volatile asset class, so to speak, in that sense. And similar for silver. In fact, silver took perhaps longer after its peak in late 2011 to come back to that level, and then obviously shoot beyond that, right? So that's something I think investors should acknowledge, that, well, yes, gold can be a great risk diversifier in their portfolios, but you need to think about it judiciously about how you allocate in your portfolio, right? So I'll share some data we actually ran in terms of analysis that we did. That if we had a traditional portfolio for an investor, which is 75% equity, 25% fixed income. What we did is we ran different simulations looking at obviously the historical correlations of gold versus the Indian equities and Indian fixed income, and we looked at what allocation of gold would probably be a good sweet spot to add to a portfolio as a diversifier. So what the results showed us is, at a 10% allocation to gold, by reducing equity from 75 to 65, you actually get a very sweet spot in terms of the overall risk in the portfolio comes down quite significantly. And you're not compromising on the expected returns of the portfolio, right?
Okay.
So I think that's how you would allocate to gold, and not haphazardly increasing beyond a certain level.
Kaustubh, we do actually have a lot of questions, but we are completely out of time in this segment. But we'll take this forward some other day. But thank you so much for joining us, as always, with your insights and expertise, specifically this time on what's happening in the world of passive funds. With that, we'll do one thing. We'll take a quick break. On the other side, we'll talk about SWP, Systematic Withdrawal Plan, and SIP, the different styles, with A. Balasubramanian of Aditya Birla Sun Life AMC.